I'm sorry. Welcome back to Strongman Personal Finance. Woo! I decided to do a video on Walgreens stock today. And I just freaking fell asleep reading about this garbage stunk. Now, why am I doing Walgreens? Well, one of my favorite YouTubers, Jeremy LaFafa, LaFufu, LaFifi, whatever you want to call him, he's a big fan of the stock. I don't know why. I think his thesis was COVID shots. So that's why he's pumping the stock on his fans. But in my humble opinion, if you had the choice between investing in a total world stock market index fund or putting money into Walgreens, I would rather you put your money in a total world stock market index fund. And that's because unless you're going to have absolute banger performance, why would you not put your money into a total world index fund? If you want to buy an individual stock, you're doing that because you believe it's going to knock it out of the freaking park. Because if it's not going to do that, let's say it'll maybe get an 11% return as opposed to a 10% return, why even waste your freaking time? Why even take the risk of potentially getting 1% more when you could just buy every company in the freaking world? Now let's check out Walgreens. We're going to look at Morningstar's analysis, which I thought was pretty good. And then we're going to look at some of the ratios. And I'm going to tell you that I don't see why Jeremy likes this stock. I mean, it's not a horrible stock. At least it's profitable, but there's just some things I don't like the dividend, way too high. Yeah, PE's fine, whatever. But I think it's a slowly dying company with no moat. Now, here is Morningstar's analysis. And if you go to your local library, you can probably get a free subscription. Now, the first thing that caught my eyes is gross margins have steadily declined from just under 30% to 20% in 2020, primarily as a result of reimbursement pressures from pharmacy benefit managers. Now, when your gross margin goes down, that means you take your whatever you're selling your items for, I guess like drugs and whatever degeneracy Walgreens is selling, and you subtract out the cost of goods sold, which is the cost of the materials you bought or the items or the inventory you bought, and that gives you your gross margin. Now, if your gross margin is going down, that's pretty high up the income statement. So the more that goes down, the larger the ripple effect as you go down the income statement. So by declining gross margins, that means the company is becoming less and less profitable. Now, I looked at the 10K, and they're going through some kind of cost-saving initiative. But still, come on, if your freaking gross margins are going down almost 10%, that's pretty freaking bad. So that's the first thing that caught my eye, and we'll actually go look at the numbers. The next thing I saw was blah, 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 blah. Economic moat. We do not believe Walgreens possesses a moat. Despite the retail pharmacy's chain's scale and brand, the company lacks structural advantages that typically support a moat in a highly competitive retail landscape. Yes. Now, I never go to freaking Walgreens. And here's why. Because you walk in there, and all the freaking stuff is expensive. It's overpriced trash. I'd rather go to Walmart and do my shopping with much more affordable items that aren't a complete freaking ripoff. And then if I want to stop at the pharmacy, which Walmart also has, I can do that. Now, I don't see the appeal of Walgreens just on like a personal level. I think it's a freaking ripoff. But think about all the competition Walgreens has. Prescriptions are getting delivered now more and more often, which means there's less foot traffic in the Walgreens stores. You got Amazon entering the prescription space. You got Walmart. You got all the other freaking pharmacies. I mean, Walgreens' moat is non-existent. I think Morningstar's analysis is right. What is special about Walgreens as a pharmaceuticals business or, a retailer of pharmaceuticals? There's really nothing that special about it. So no moat and declining margins, and you have massive companies entering the space. Amazon, Walmart's already in the space. I don't know if Target has a pharmacy, probably not. Freaking liberals. But Costco has a pharmacy apparently. I mean, this is just not, I don't get it, Jeremy. I don't understand. I know. Maybe he's looking for a quick pop. Maybe he's doing like a speculative trade where, because like Walgreens has been down pretty significantly over the last 5 years. That doesn't necessarily mean it's a bad investment because past performance doesn't really mean anything. You want to look at where the company's going in the future. But maybe he's thinking, okay, it's been temporarily down and maybe it'll have a quick run up and I'll sell out of it. That's probably what his analysis is. But let's go look at the ratios. I mean, Jesus Christ. Revenue 3-year growth, 5.68%. That's pretty freaking weak, okay? If you want to invest in an individual stock, don't you kind of want a banger? Something that's going to blow it out of the water? Net income growth, negative 51%. Operating margin, trailing 12 months, 2.4%. That is a very narrowly profitable company. Return on assets, 2.57. Net margin, 1.57. That's the bottom of the income statement. So for every dollar they make, for every $100 they make, they have $1.57 of profit. That's really not that enticing. We can go look at more ratios. We can actually look at the how the gross margins, which are very important, have been declining. So here on the sheet, here on this financial sheet, we have revenues, and then we have gross margin, and we have operating income. Now, look at the gross margin percentage, which you take your revenues minus your cost of goods sold, gives you your gross profit. Take your gross profit divided by your revenues, that's your gross margin. Now, looking at here, in 2011, they had a 28% gross margin, 28, 29. Pretty standard, huh? And then it starts to go down in 2015, 26, 25, 24, 23, 22, 20, 19. You see a trend there, ladies and gentlemen? This company is getting squeezed because there's so much freaking competition. If you don't have a moat, your margins are going to go down because you're competing with everybody else that are also trying to take you over. And on top of that, okay, the revenue growth is just not that impressive to me. 2018, 131. 2019, 136. 2020, 139. Trailing 12 months, 146. Okay, they got a decent little boost in the last 12 months, but I just don't see it. I mean, it's okay. It's not mind-blowing. At least it's profitable. I'll give them that. Let's see. Free cash flow. So free cash flows have been going down, or they've been basically stable. So in 2018, they had almost $7 billion in free cash flows. And then the next year, they had $3.8 billion, $4 billion, $5 billion. So it's okay. Free cash flow per share, it's been going down every year. I mean, I just don't get it, Jeremy. I don't understand. Now, you could do a discounted cash flow analysis of this company, and maybe the company is trading below its expected, discounted future cash flows. But just looking at this, I don't think I would invest in this stock. There's just nothing special about it, okay? And the last thing I'll say is, here's what I really don't like about this stock. Okay, here's Morningstar's fair value, $44. It's at $46 right now. Where's the freaking dividend? Quote, 4.15% dividend yield. I will say this 1,000 times. Dividends are tax inefficient. Just because it has a high dividend doesn't mean it's a good stock to invest in. As a matter of fact, I'm generally turned off by high dividends, okay? That's because the higher the dividend, the more the company is paying out its profits to you and the more freaking taxes you have to pay. Now, the company can also reward you by buying back shares, and that's actually more tax efficient. Jesus. But now, come on, 4.15, that's like almost double what the S&P 500 is paying right now. So even if you wanted to buy this stock, you can only do it in a tax advantage account. And in my opinion, if you have money in a tax advantage account, I'd rather you put that in an index fund. But that's just me. So I'm giving Walgreens a thumbs down. I think it's trash. It's boring. It's yawn-inducing. Has no appeal. I don't get it, Jeremy. I don't know if I really don't know what Jeremy's thesis is. I mean, I really think it's like, oh, there's going to be COVID shots and maybe it's down temporarily and it'll pop back up. But this is not. Think about the long-term viability of this company. Declining gross margins every freaking year. Massive competition. No moat. High dividend. Come on, ladies and gentlemen. Not the end of the world stock, but just not impressive to me at all. Anyway, that's it, ladies and gentlemen. You can go buy this crap if you want. I don't care if it goes up or not, but for a long-term viable business, I don't like it. Not impressed. But you do whatever you want to do, ladies and gentlemen. Anyway, that's it. Have a wonderful day.